Okay, let's do some equity. What were we doing? We recorded issuing stock. We talked about par values, right? Stated values. We talked about outstanding shares or authorized, issued, outstanding. What's the difference between issued and outstanding? Issued means, yeah, you sold it to your shareholders, right? Those aren't sales, right? It's just contributed capital. It's issued stock, right? Debit cash and credit contributed capital accounts. Debit cash, credit common stock for par, stated value, and credit additional paid capital for the rest, right, guys? You do this in your sleep. Or whatever you got, land, building, equipment could have been the debit. You still credit common stock, okay? Additional paid capital. By the way, preferred stock works exactly the same way. Preferred stock usually has a higher par value, but so what? You debit cash for whatever you got for it, right? You credit preferred stock for the amount of its par value or stated value, and you credit additional paid-in capital on preferred stock. Preferred stock, credit, and then credit additional paid-in capital on preferred stock. That's it. So they both are exactly the same. Just one's called common stock, one's called preferred stock. You're welcome. I ask you for both of those problems. Okay? All right. So what's the difference between, though, issued? That's when you sell the stock, right? So authorized is how many you have the right to issue, right? Artists and corporations say that. Issued is how many you did issue. Guess what unissued is? The ones you haven't issued yet. And big deal. Okay? What's the difference between issued and outstanding? It might be the same number. A lot of financial statements, you look at them, it'll say shares authorized, how many? Shares issued and outstanding. Issued and outstanding will be the same number. So that's authorized 1 million, you know, and then issued and outstanding will be 400,000. But sometimes they're different numbers, the issued and outstanding. What is it?
Outstanding is the difference between issued and treasury.
Yes. What does treasury mean?
If the company buys something.
Yeah, buy back your stock. Can you invest in yourself? What an absurd concept. Of course not. So when you buy back your stock, you're effectively retiring equity, right? By the way, you can formally retire the stock if you want. You can buy it back as treasury stock, and then you can formally retire it, as in you're not going to issue it again. Or you could buy it and then later reissue it. Sometimes, if you think your stock's selling for too little, sometimes management will buy a whole bunch of their stock so that they can jog the marketplace. I don't know, maybe it works. Okay? Sometimes you have shareholders that you really can't stand. They're a thorn in your side. You buy their stock, they're gone. Of course, the stock's get rid of it. Where there's a takeover artist, people that are trying to take over possible takeovers of companies, they'll buy a whole bunch of stock, and they pay them something called green mail. They pay them a whole bunch of money buying their stock to get rid of them, so they can't take over the business. That is real debatable whether that's good for the company or not, right? It protects the management of the company, but what if you're a shareholder? And they give some other shareholder a whole bunch of money to get rid of them. I'd like them to give me a whole bunch of money to get rid of me too. What do you think? Right? You know what I mean? So they're transferring your wealth to them to protect their jobs. So this is a real controversial area. Okay, but anyway, treasury stock. How would you record it if a company buys it? So let's say that I've got 400,000 shares outstanding and I buy back 10,000. And I buy back the 10,000 for the current market value. I just go out, it's publicly traded, and I just buy it out in the marketplace. And let's say it's selling for $5 a share and I buy back 10,000. What do I buy it with? Let's do the journal when I buy it. Yeah, credit cash. What did I say, $5 times 10,000? $50,000. Everybody agree? This is called the cost method. There are other methods, market method. Let's just do this. Okay? I would debit treasury stock. Okay, now what I want you to do is ask yourself what kind of an account is that? Immediately. What kind of an account is that? It's contra equity. You got it. Because you can't invest in yourself. Excellent. It's contra equity. Okay? So that's the deal. Right? I got contra equity. What am I going to do with that when I do a balance sheet? Show it at the bottom of the equity section, right? After retained earnings even. Treasury stock. Less treasury stock. Got it? Okay? So I guess you think if you took some of your retained earnings and bought back treasury stock. On the equity statement of the company, you'd have a column for treasury stock. Sound good? That's all it is. Contra equity. So therefore, what kind of a balance does it have with contra equity? Look at it. It's a debit, of course. You increase it with a debit, how are you going to reduce it? With a credit. Okay? But this is not an investment. It doesn't go into assets, right? It's yourself. It's your own stock. Okay, so you have that much less equity. All right, so let's say this was on January 1st, and then January 10th, we sell something. Okay? So this was 10,000 shares at $5 market value. Got the idea? And let's say we are now on January 10th able to issue, oh, I don't know, let's issue 6,000 of them for $6. I don't know how we managed that. In 10 days, the price went up a whole bunch. Okay, but anyway, so I'm going to issue 6,000 at $6. Sell 6,000, right? Not issue new shares, right? So 6,000 shares. So I had 10. I'm going to issue 6, and it's going to be at $6. How much cash is that going to be coming in? Debit cash. 36,000. We're going to treat this just like we would an asset, even though it's not one, right? I bought them for 5, right? What should I record going out? If I record them in the treasury stock at 5, when I take them out, what I better take them out of?
30,000.
Yeah, $5 times 6,000 is 30,000. You got it. So treasury stock, this same account as this one, right? Treasury stock is going to go down by 30,000. Now the temptation is to say that's a gain. But let's think about this. Can I have a gain by buying back my own stock and then reissuing my own stock? A gain, like more income? No, you can't make a gain out of yourself. If so, I'd issue myself stock. Then I'd buy it back for myself, reissue it to myself, because I'm so wealthy, I just do it over and over and over. Capture all the wealth in the world. You don't get richer by doing business with yourself.
Paid-in capital.
Yeah. Additional paid-in capital. What, have you been studying or something? That's just terrifying. Okay, anyway. Additional paid-in capital on treasury stock. So, what kind of account do you think that thing is? Additional paid-in capital treasury stock. That's additional equity account. So there's another one. There's only a handful, but there's another one. You could have additional paid-in capital from the sale of treasury stock. You like it? Okay. All right. So then something happens. It's now January 20th. Boy, is this a volatile stock. And we're going to sell the other 4,000 shares for $3 a share. We're just getting green numbers, I guess. Okay. I'm making my numbers go. Okay, so I sell the other 4,000. I'm not going to have any treasury stock left anymore. So if you think about treasury stock, what's happening? You put 50 in, right? And then you sold 30 of it. What do you have left? Reissued. You got 20, don't you? All right, guys? So now I'm going to sell off the rest of it. Okay? So it's going to be another 4,000 shares, right, guys? Everybody good? And I said what? $3? Okay, so what's that? 12,000 cash? It's too easy. What don't I have anymore? Treasury stock's gone. How much is that? It's got to be the whole 20,000 because it's going to go to nothing, right? What's it going to be? $4,005, right, guys? These are almost 3 points on the Quizzer test. If you think about it, you get this down. Big deal. Okay. So what do you want to do? Let's say this was the only time I'd ever bought treasury stock. So what do I have on additional paid-in capital in treasury stock? How much is in there?
6,000.
I only have 6 in there, don't I? What's the least it could go to, I suppose? 0. You can't go beyond 0 in an additional paid-in capital account. It's ridiculous. So if I issue these again at 12 and they're on my books at 20, how much can I take out of additional paid-in capital? Only 6. That common sense to you guys? Additional paid in capital. There we go. For 6,000 on treasury stock, right? This is different than additional paid in capital, common stock, or additional paid in capital preferred stock. It's another account, right? Additional paid in capital treasury stock. So I take the 6,000 out of here, and guess what? That brought me down to the 0. Yeah, we're good. All right. But I need another $6,000. Oops, 18. I need another $2,000. Debit. You're going to call that a loss? No, you can't have gains and losses on your own stock. So what we do is we say, well, what must have happened is we took some of our retained earnings and gave it to these new owners by issuing stock that year. Effectively, I used some of my retained earnings to change owners, I guess, huh? What do you think about it? Sort of a plug in a way, place to put it, but it reduces my equity, okay? So, retained earnings. And that's it. Just not a big deal. Okay. Now, if you've read this chapter, which, oh, I hope everybody's done that, you've been working this stuff, right, looking at it, it's pretty simple. I show you examples. I just showed you an example. There are problems in the book. I'm going to give it to you on the quiz. It's probably on the test, probably fine. Okay? At least a couple of those places. Okay. You going to have these points? Why not? Why not? Get your head back into this stuff. You guys are doing great. The first test, what was it, 68% average or something on the first test? Oh my gosh. I thought, geez, we have a bunch of geniuses in here. This is just scary. Yeah, 68.2. This one's 46. This material is harder than the first material? No, it's not. It's easier. It got easier. It's just based on the first material. And it's no particular problem. There were 18 points for knowing how to do inventory methods. Exactly the same question, exactly the same type of question that was on what? The practice quiz. We did it in class, we did it in the practice quiz, and then I gave it to you on the regular quiz, that's right, and then I gave it to you again. What was different? I asked, what would gross profit be? What's gross profit? Sales less cost of goods sold. Once you calculated cost of goods sold, there were only two sales. Did you figure out what the sales were? They were the same no matter what the method was. All you had to do was take the sales less the cost of goods sold. Everybody that got all, what's it, 6 of them? All 6 methods right. If they got all 6 methods right, they also, for inventory value, also got all 6 cost of goods sold, also got all 6 gross profit. Yeah, all of them. You guys know what that stuff is, right? Okay. Come on, come on. Anyway. I have total confidence in you. You'll start working again. Start doing it. Put it together. We have a while before we do a test, though. 2 more chapters to do. You know, we got a whole 3 weeks left or something. 2 weeks left.
So you don't have test until July 28th.
Yeah, July 28th. What's today? 15th hour. Couple weeks. You can put in a lot of hours before that. You know, 30 a week, maybe. You blew off a few weeks. Maybe. Okay. All right, so let's do something else. Let's do some dividends. Okay. So let's do stock dividends and stock splits. Okay. So we'll do stock dividends. There's 2 types of stock dividends. What are they? Well, we could prefer dividend and common dividend, that's true. For stock for both, okay, well, let's just do common stock for now, okay? We usually don't do stock dividends for preferred stock, okay? But, yeah, and cash dividends could be for preferred or for common, okay? Stock splits could be for both, too, for that matter, but those are always common, too, okay? But what do I mean? The 2 types in terms of what? Whether we account for them differently in terms of a stock dividend. Stock dividend is what? I give the shareholders what? More stock. I don't have any cash, but I can always issue more shares of stock if I have unissued stock. Why would a shareholder want more shares of stock? The company still makes the same amount. You divide it by the number of shares, and there's more shares. Yeah, what happens? Maybe they didn't really give me a dividend, or maybe they didn't really give me a stock or a real dividend. They gave me a stock dividend, but maybe they didn't give me a real dividend. Because if it's my earnings per share go down by the amount of stock that I have, so here's the deal though. We might pay $1 dividend every 6 months. This is the policy of the company. If I issue a stock dividend, what could happen? Now everybody has more shares. All my shareholders have more shares. If I keep giving $1 dividend in cash every 6 months, they might get more that way, right? The other thing that could happen is the stock value that could go down by as much as the increase in number of shares. Does that make sense? So I might have a little more value just by virtue of the fact there's more shares and the market doesn't adjust, right? It might help me that way. It's possible, okay? But it's a way the company can give shareholders a dividend when they don't have the cash. So it might be better than nothing. Okay? But there's 2 of them here. What is it? Big and little. Look at it. Big and small. Large and small. Okay? What percentage is large? What percentage is small? Gotta take a look at the chapter. What do they say? Gotta know that. You can't do this. What's a large stock dividend? What's a small stock dividend? We account for them differently. Because we make a different assumption based on the fact that they're small and large. What percent of the shares? Like a 10% stock dividend would be, everybody would get You know, if you own 100 shares, you get 10. If you own 1,000 shares, you get 100. You get 10% whatever you own, right? There's 10% more shares issued now. What's big and little? You guys did read this, you consider this very carefully. Maybe I shouldn't have given you more time for the test, huh? I think this is good as four. We'd never get like this done on Wednesday. And you've been studying this stuff instead of blowing this off. You did nothing because I gave you more time. Wow, some of you, holy crap, that's awesome. What's big and little? Can you find a stock dividend?
I think it's more than 20 to 25%.
Okay. So when we get up around 20 to 25%, I think that's really huge, personally. Do you think the stock price will adjust if there's something 20 more shares out there? Say there's 100,000 shares that are being traded, right? And now there's 120 or 125,000. I think the market price is going to go down, right? It's the value of the company divided by the number of shares should be the market price. Okay. What's small? Less than that. So over and less than. You need to know that. And it's a rule of thumb, right? 20 to 25%. And what I'll do is I'll give you a small one, and I'll say, well, the small, let's do an example. Small is a 5% dividend, okay? And then as a large, I'll give you 30%. So it's very clear, something like that. I'll do real small and real large. The assumption on the small is the market price won't adjust. I think it's a little silly to be up to 19% and won't adjust. I think it will. I think small ought to be 4% or 3% or something. But this is how it's set up. Okay? It's how we do it. So generally, accept the accounting principles. All right. So let's do examples of 5%, 30%. Let's say we have authorized 1 million shares. Okay, guys? Let's say we have issued and outstanding, no treasury stock, okay? 400,000 shares. Okay, here we go. What I'm going to do is I'm going to take some of my unissued shares and give it to my shareholders. Oh, let's talk about treasury stock here, though. How many shares are you going to give in a stock dividend to the unissued shares? How many are you going to? How much dividend do you have in unissued shares? You never issued it to anybody. The company's still holding. So you're going to give yourself some unissued shares, like your unissued shares. That'd be ridiculous. You don't give yourself a dividend, right? Doesn't make any sense. By the way, would you pay yourself a cash dividend either? No. You would give yourself a stock dividend or a cash dividend. When you do stock splits, though, you will. I'll show you that in a few minutes. Okay? It's just that we're splitting everything up. Okay? It's just going to be more shares. All right. How about the treasury stock? You're holding those too. You're going to give yourself a dividend on treasury stock? Doesn't make any sense. Why would you give yourself a dividend? So you're not going to give yourself a cash dividend or a stock dividend on treasury stock. So if there's treasury stock, leave it out too. It's only going to be the outstanding shares. Make sense? Those are the ones that are being publicly traded. They're the ones that are out there. If I'm valuing the company, those either take 211, we're going to be valuing the company, right? Model called weighted average cost of capital, capitalizing price, right? And by the way, the rest of you, when you do BA 315, right? If you're a business major, finance class, you're going to do it the same model, exactly. Okay? So what we're going to do is we're going to value outstanding shares, not the ones we're holding. They don't have any value. That makes sense? Really what each share is worth is the market value of all the assets of the company, less the market value of all the liabilities of the company, which is the market value of the equity of the company, divided by the outstanding shares. Isn't that what the market value of each share is? In fact, you can take the market value per share times the outstanding shares to find out what the company as a whole is worth, their equity is worth, right? You go the other direction. You can take that total equity and add it to the total liability market value, and that'd be the total market value of the assets. It just is, right? It's got to be. You really need to get your head around that as we go forward, okay? And it's pretty tough at this point, right? You're just trying to figure out what an asset, liability, equity is still, sort of, okay? But you got to have the language first, or you can't understand the concepts, okay? All right. Anyway, so let's do a small dividend. Here's the deal. On the small one, we think the market value doesn't adjust. So what we need a couple more things. Here's the par. Par or stated value, either one, right? Par is $1 per share, okay? And let's say we have a market value of $10 per share. Got the idea? Let's record it. What I'm doing is I'm taking some of my retained earnings and converting it to stock. That's all it is. So in both cases, so let's do the small one first. We said 5%, right guys? I am going to debit retained earnings, reducing it, and credit common stock. In both cases, I'm going to do this. Okay? But on the small one, I am going to record it at market value. Small is going to be at market value, okay? And the reason is I think the market value is not going to change. Guess what I'm going to do when I do the large one? I'm going to record it at par value because I think the price is going to adjust for it. Okay? That's what you got to know. You got to know how big a small one is, less than 20 to 25%. How big a large one is, more than that. And you've got to know which one's going to record at par. Well, that'll be the large one because market value is going to go down, right? As a result of having more shares. And the small one's going to be at market value because we make the assumption it's not going to adjust, at least not as much. Okay, so how much am I going to record then for the small one? How many shares is it going to be? Let's do the shares. 5% of what? Yes, sir.
I'm sorry, just what are we recording? Like, what is the like scenario?
I am giving shares to the shareholders. I have people out there, owners, who own 400,000 shares. I'm giving them a stock dividend. I'm going to actually give them pieces of paper that represent ownership in the company. They won't own 400,000 shares in total anymore. How much will they own if I give them a 5% dividend? What's 5% of 400,000? 20,000, right? 10% would be 40, right? So 20,000. How many are going to be issued and outstanding after I give them 20 more? 420. The existing shareholders hold 400,000 shares, right? I'm going to give them 20,000 more. There's going to be 420 out there. That's all I'm doing. What was the large one? It's going to be 30%. 30% of what? 400,000. I'm going to give them 120,000 shares. There's going to be 520,000 shares out there. Thank you for the question. That's it. That's what a stock dividend is. It's supposed to be up there this chapter. I would cut it half of it. We're finishing it today. We do the quiz tomorrow. Being suicidal in this class or something. You only throw away one quiz. You can't blow up a whole bunch of them. Lovely. I don't modify very much the curves. Grading you against everybody I ever had for this class. Now to about normal GPA, 2.3, 2.4. Right? I've had as low as 1.6. As high as 3.0, for instance. Okay. Start reading chapters again. Dig in, go after it. You guys need to stop doing anything else with this. And if you have another class, you don't do. You don't do anything but those two things for 2 weeks. Don't have any friends. Don't be on Facebook. You're not very busy anyway. What would you do on Facebook? Well, Twitter or anything else. Get to work. Or we'll do it again. Pay for it again. Stupid. Don't do that. A powerful experience. One is horrible. Two is expensive. Plus, we'll take a longer drive if you do enough times. That's tough. Good stuff. And I'm only talking half of it. The other half is good fun. So, yeah, it's always like that. But even the ones who are doing well haven't read this chapter. Have you? Okay. I have a clue in this thing. All right. Anyway, or at least you didn't read it carefully. Or haven't done any homework at least. All right, so what do we do? How many shares we got? For the small one. 5% of the 400,000 outstanding. I'm not going to give any shares to myself, right? So the other 600,000 that aren't issued, I'm not gonna give myself any shares, what for? I'm not gonna give myself a dividend, doesn't mean anything, right? Okay, so it's gonna be how many shares? 400,000 times 5% is 20,000 shares, everybody agree? Okay, so I got 20,000 shares. Times what? Market value, excellent, $10, how much is that? 200,000 times 10, what do we get? Or, yeah, 20,000, I apologize, times 10, 200,000, good math. $200,000. Now we got a problem. How do I record common stock? How do I always record common stock or preferred stock when I issue it? Stock when I issue it. I record it at what value? Come on. Par value or stated value, right? Okay, so unless it's a no par state, then there's not, the whole thing's with the common stock, right? Okay, so what's the par value? $1. How many shares are there? 20,000. How many dollars is that? So what's going to be the $9 a share times 20,000 shares, or 180,000, of course, which is what I need in a way of credit. What is it? Yeah, additional paid-in capital and common stock, just like I was issuing it for cash or land or buildings or something. Everybody see it? This is simple too. Once you get your head around it, once you realize what's happening. That was a great question, by the way. You have questions like that, ask. What are we doing? What's happening? Okay? All right, good. So that's the small one. That's all there is to it. You're there. Okay? Now how many shares, you guys, are issued and outstanding? 420, right? Good deal. So I was doing earnings per share, I take my net income and divide it by 420. Before it would have been 400. If I'm paying a cash dividend, I'm going to pay cash dividends on 420,000 shares instead of just 400. Got the idea? There's more shares out there. That's it. Now, if you owned 1,000 shares, how many shares would I give you? You're one of the owners, and I'm the company. If you owned 1,000 shares, I'd give you what? 1,000, 50. Right? 50 more. So she have 1,050. Do you think her investment's worth more? I don't know. Maybe if the market price doesn't go down very much, right? Or it doesn't go down at all, it's certainly worth more. Right? But what if the price adjusts? Might not be worth any more at all. Do you own more of the company now? You own 1,000 shares out of 400,000. Now you own 1,050 out of 420,000. You have the same boat you had before. Everybody got the picture on this? Okay, so let's do one that's big. Okay? This one's easier. This is the big, the large one. Here we go, guys. Guess what I'm going to debit? I'm taking some of my retained earnings and issuing stock with it, right? So I reduce my retained earnings with a debit, and guess what I'm going to credit? Common stock. Very good. This is just not hard. It's the other thing. You guys were really working on everything we did. You were trying to get it down. You were trying to keep it. You were trying to add it to your knowledge set. And then you just stopped. And thought, oh, it'll be okay. I'm doing really well. It'll be okay. It doesn't work that way. You can't go to work and really work your ass off and impress your boss and then check out and not come to work for 3 days. You destroy your credibility, right? Here you destroy your grade. This is no big deal. You can recover it, do it again. Actually, at work it's no big deal either. You can always get another job and reestablish yourself and, redo all the work to get your reputation built again. All the work you put into building your reputation, showing your work ethic and stuff, maintain it. That doesn't mean you can never drop the ball. It's okay. You can. Everybody does. Everybody flakes out. But people that are really going to make things happen, what do? Dig back in and go after it, right? Dig back and go after it over and over and over and over, right? Always apologize, always take responsibility. Don't apologize to me, please. But, apologize to your boss. Yeah, and then work all weekend. It's awful. Do everything you didn't get done because you played out. Right? Gotta do it. Okay? Gotta reestablish who you are. All right, anyway. So what do you want? 30% is how many shares? 400,000 times 30 is 120,000 shares. Boy, I bet the market price will adjust on this one, huh? Because now instead of 400,000 shares outstanding, how many are there going to be? 520 issued and outstanding, right? A lot more shares. I bet our dividends per share go down too. Right. When we start paying dividends, you're going to have to. Okay, anyway, what do we want to record the stock at? This time it's going to be the par. So how much debit to retained earnings? $120,000 a share. How much to common stock? 120,000. Looks funny, doesn't it? The one that was 5%, we reduced retained earnings by 200, and the one that was 30%, only 120. Why is that? Well, the market value of 10 is an awful lot more than par 1, and that's why. Everybody see it? That's not very hard, is it? Okay. I bet you see this on a quiz test fun. Huh? Okay, it's pretty straightforward. There aren't very many different issues in each chapter. Right? Can you handle them? Okay, that's basically it. Okay? Dig in and get it.
So will par value always be large and market value always be small?
No, par value will always be small, and market will be larger. Par value is dollar.
Yeah.
Oh, no, it just depends on how many shares you have. I see what you mean. In total? Not necessarily. How about if my small one is just 1%, that would be 4,000 shares at $10 would be, what's that, 40,000? I could have made it 40,000, and this would still have been 120, right? It's just that I had a real low par, and I had 5% here, so it just the math just worked out that way. But if I just made it a 1% dividend, that'd be 4,000 shares at 10 or 40,000. That number would be 40,000, right? And this would still be 120 plus 30%. That's just how the math worked out. Good question. Yeah. But it can easily happen that the small one is a bigger hit to retained earnings than the larger one, right? Especially if the stock is a par by the dollar and selling for 100, you can imagine what happens, right?
He was saying, does the small percentage always go along with market value, and does the large percentage always go along with market value?
Is that what you're asking me?
Yeah.
Oh, yes. The deal is, I thought you meant, why is that number bigger than that one? Okay, the deal is, if you do a large one, you are assuming that the market value is going to adjust down, because there's so many more shares. So you record those at the par, okay? On the small one, you're assuming the market value won't adjust, at least not fully. So on the small one, we always use the market value. So the answer to that question is yes. I apologize. Okay, yes. That was kind of a strange question. Yeah. Yeah. Okay. All right, gang. So, everybody good on the stock dividend? All right. Let's do cash dividends. Right? That's the other piece. These we like, if you're a shareholder. Although, I don't care if I get dividends or not when I own a company. Own shares in a company, own stock in a company. What happens if they don't pay me dividends? That dividend. When is the money? Goes back in the company and they do what? Reinvest it, which means buy more assets, pay down liabilities, right? That's investment. Buy more assets, and then they use those assets to do what? Expand the business and make me richer. So my share price, right, the market value of my stock, might go up more if they don't pay me dividends. Right? You take dividends out, what's happening? You're taking out some of the earnings, right? So of course the stock price is going to go down if you pay dividends, right, guys? Everybody, does that make sense? Okay. So if the company can earn more with what they would have paid me in dividends than I can earn myself, I'd like them to keep the money and have it grow. Let's say if they give it to me, I have to reinvest in something, and let's say I could only earn 12%. But they have something they can invest in where about the same risk level they can earn 15. What do I want them to do? Keep investing. When do I want them to pay me dividends? When they don't have anything to do with the money. They can't figure out what to do with it. And there are companies that actually have that much. Microsoft, right? And they just have more cash than they could possibly know what to do with it. And they didn't pay dividends for a long time because several extremely wealthy people own so much of the stock that they didn't really need the dividend. But so they started finding pain, right? And also they started giving money away and stuff, right? After he got married. It's always women fix things, right? The guy just made money, he didn't even think about it, right? He just made more and more and more and became more and more wealthy. He wasn't even giving anything away. He got married, kind of, what are you going to do? Leave this to our kids? Oh my gosh. So start giving money. Warren Buffett's giving it away, right, big time. What are you gonna do with it anyway? Right, when you have buildings. Okay, question?
Yes. Didn't you say at like one time, wasn't it a company like General Motors or something, they always give dividends even when they show a loss? Why is that?
Yeah, they think there's a message in it, a signal. It's signaling theory, basically. They think there's a signal that we are really stable even though we're having a rough time right now. So we are communicating to the market by paying a dividend, even though we might have a loss or real low income. We pay the same dividend to show that we're really a strong company and we're going to weather through this and everything will be fine. It doesn't have any impact on me, and I don't think it does on most analysts that are very sophisticated. And it's just fine. They do. Some people would say, though, that I want to buy dividend stocks or I want to buy growth stocks. What's a growth stock? It doesn't pay dividends. It grows instead. Right? It's the idea. Right? Dividend stocks don't really pay all their profit out in dividends, but they always pay dividends, right? Let's say that your grandparents wanted to give you money to give you stock, and you're going to go to college, and they know it, so they want you to have payments coming out of that. They could buy dividend stock, and then the dividends get paid to you, and that's what you pay your tuition for. Make sense? It'd be all right. But really, you could sell stock instead and get the money out anyway, right? The portion you need. So either way, you can get your money out. Does that make any sense? Used to be true if they paid you dividends, you'd have to pay tax on it, and that's still true if you take the dividend out in the form of cash. But a lot of times what happens is we'll have investments in mutual funds. If the company pays a dividend, the mutual fund automatically reinvests the dividend anyway in some other company. So it doesn't make any difference if they pay me a dividend or not. The stocks that I'm holding through mutual funds, when they pay me a dividend, I don't take it. I don't want it. Well, with money, my wife would love it, but we'd have to pay tax on it, right? So 40% of it would disappear instantly, right? If I actually take it as taxable income, it's going to go to the government, right? So I do that. That makes sense. Right? So it gets reinvested anyway. So dividend policy, we call it, it's not a very big deal anymore, right? For most people. But companies still worry about it. Yeah, there are companies that always pay a dividend, right? Everywhere, like clockwork. They'll pay it out. Yeah.
This is just kind of random, but do you remember like 2 years ago in I think Greece when the government seized all assets and everybody's bank accounts and all this everything?
Yeah.
Like what are I was gonna ask my mom because I'm like really interested in stocks and stuff like that. What are the possibilities that could ever happen here?
Oh, not likely. Not likely. You have to have a flash for the economy for those sorts of things to happen. In democracy, particularly, that's the most you can have an overthrow of the government by reasons sometimes. That's a bit far-fetched for us, probably. I saw something that's really scary that's true. It's facts going through, Facebook sites, I guess. And this claim was, anyway, that we have 5% of the world's population and we have 50% of the world's guns in our society. So, who are we defending ourselves against? Each other. Maybe, when you become 18, you should be issued a gun instead of a car. Is that where we're going? It's kind of scary to think about it. But I also saw another thing that was in Black Month that suggested that fewer and fewer people in our society own guns, but we have more guns than we used to have. A relatively small group of our population arming themselves. Fewer and fewer people own guns, right, as a percent of our population. More people own guns, but it's smaller. Actually, maybe it's not people, maybe it's fewer people. It's kind of a weird phenomenon, isn't it? But fewer and fewer people own them, but there are more and more of them. Wow.
Some people have like a fetish with it.
Yeah,
It's like,
a fetish.
like they have huge collections.
Yeah. But collecting historical artifacts is okay. Have you been to the museum downtown, the Traeger Arms Museum? It's really cool, isn't it? It's history, guns are part of our history, and it's certainly part of our present. But it is strange collecting assault weapons, that's cool. Now, mostly men, isn't that sad? Yeah, so okay. So, cash dividends, huh? Did that sort of answer your question, though? It was really economic collapse and they, yeah, they have so much national debt, they don't have the capacity to pay it. Might not have been Greece, because I don't know if they nationalized things in Greece.
I don't know, I just remember, everybody woke up, next thing you know, everybody had $0. And then it was whole.
Yeah, I don't know if Greece got quite that bad, but it's pretty bad situation, economically. Okay, so let's try cash dividend. How would a cash dividend work? This time, let's assume we have preferred stock and common stock, okay? Let's say we have 1,000 shares. We did a preferred stock issue. It's $100 par. And it pays a 5% dividend, okay? And then let's say on common stock, we have 100,000 shares. Both of these are issued and outstanding, okay? And it's a $2 par. Okay? And there's no stated dividend on common stock, okay? So how is preferred stock preferred? Well, one way they're preferred typically is they get their dividend first, and then anything that's left over goes to the common shareholders, okay? So that's real typical. Another thing is that in liquidation, if you close down the company, right, sell off all the assets, first you pay off all the debt, right? Because debt holders have the first claim. It's less risky than stock, right? Then preferred shareholders get paid. So it might be that they get 105% of their par value, or they get 100% of their par value, or you pick a number, right? Okay, at least 100%, but it might be more. Of their par value to liquidate the company. They get that before the common shareholders get anything. But what if there's not enough money to give them anything? Let's say the company's really in trouble, and it barely covers the debt when they sell the assets, or it doesn't even do that. They declare bankruptcy. What happens to preferred shareholders? They lose their money too, right? That makes sense? So they're sort of in between debt and common stock, okay? In terms of their value. But they get paid first. So as a result of getting paid first, they get a lower return. So their expected return. So they're getting a 5% dividend here, right? So what's that going to be on a $100 par? $5 a share. What's going to be on 1,000 shares? $5 a share on 1,000 shares is $50. Everybody got it? It's just that simple. So, or you could say there's 100,000 total par, 1,000 shares times $100. 100,000 times 5% is what? Same number, right? The same $5,000. Okay, so this is going to be $5,000 per year dividend. Okay? Everybody got it? They get the first $5,000, right? And then that guys get anything over the $5,000. Now, this would be preferred stock that is non-cumulative, non-participating, okay? What does non-cumulative mean? If I don't pay a dividend in 1 year, they don't get it in the future. It's not interest, right? I don't owe it to them. If I do pay a dividend, right, they're still shareholders. If I do pay a dividend, they get the dividend. If I don't pay a dividend, they don't get it, right? But if I skip a year, we start over. Non-cumulative, okay? What do they cumulative would be? They get 5,000 every year, right? So if I skip a year, what do they get the second year? 10. What if I skip 2 years and it's now the third year? 15. What if I skip 10 years and it's now the 11th year? 55. They get the first 55,000 dividends get declared. Got the idea? So what would you rather have if you're a preferred shareholder, cumulative or non-cumulative? I'll take cumulative, okay? There's another feature, participating or not participating. That means after the preferred shareholders get their dividend, either non-cumulative or cumulative, after they get their dividend, then the common shareholders would get some sort of matching dividend that you would agree to in the preferred stock agreement, right? You can make these preferred stock agreements any way you want, okay? So then the common shareholders get some sort of matching dividend, right? So the preferred get their dividend first, then the common get a matching dividend, then anything that's left over, they share. And it's usually shared on relative par values. How much par value each one has, okay? Total par. So it's proportional, split. And then things get kind of complex because of that. There's another feature on preferred stock. It can be voting or not voting. What would you rather have if you're a preferred shareholder? Would you rather have a vote or not in the company? Shareholders. Sure, you'd rather have a vote. Okay. What would you rather have if you're a common shareholder? What would you like preferred shareholders to have? Not voting. Right? Of course. So voting or not. Preference in liquidation, right, or not. Okay. You know, they get 105%, 10% of their par value. They always get at least par. There's a preference there. Okay. Voting or not, preference or not, right? Cumulative or not, participating or not. So you can have all kinds of different stuff. You can make it more like debt, and less like equity, or more like equity, and less like debt. You can even have convertible preferred stock. What would that be? They convert it into common stock, right? What would you rather have? If you're a preferred shareholder, I'll take convertible. If I'm a common shareholder, I'd rather they didn't have the right to convert, right? They lose my voting share. They have the right to convert to common. Because then they can vote. Okay. We have callable preferred stock, just like uncallable bonds you read about, right? Where the common shareholders have the right to buy back the preferred stock at some agreed upon price. Got the idea? So you can structure this any way you want. It's really very, very flexible. So you can make it really close to debt. Cumulative, non-voting, that kind of thing. Non-participating, right? Okay. Or you can make it really kind of close to equity. Convertible voting. Got the idea? Okay. So, all right. Non-cumulative. Okay, so let's say that it is non-cumulative, and we'll worry about participating later or not. Okay? So let's say it's non-cumulative preferred stock. Okay? And let's say that we declare $200,000 dividend. Give me the journal entries relating to the dividend. Tell me how much each one gets. First, let's do the dividends. What would you do when you declare a dividend? At the date of the declaration, what would it be? I'm not going to pay it now. Let's say this dated declaration is December 10th, and I'm going to pay it to shareholders who happen to own the stock on December 20th, and I'm going to pay it on December 21st, or 31st, I'm sorry. So this is the date declared, December 10th. This is the date of record, we'd say. So when we find out who owns the stock, because the stock's out there selling out in the stock market, people are exchanging stock, right? Make one person to another. And this is the date of payment. So here we go. What would you record in the date of declaration? I now owe the dividend. Debit what? What do you want to do? Credit. Wait a minute. For the entire $200,000. What do you want to debit for $200,000? I'm taking some of my retained earnings and paying it out in the form of a dividend. What do I debit? Retained earnings. Oh. So for all the dividends, it's debit retained earnings. You like that? Not bad, huh? Whether it's a stock dividend or a cash dividend, doesn't matter. Okay, and then what? What am I going to do on the date of record? I find out who owns the stock. What do you want to do when you find out who owns the stock? Because they're trading it, right? So what we'd say is, you can buy stock. If you look at the Wall Street Journal, you'll see stock that says X dividend next to the name. What does that mean? Without the dividend. It means you bought it after, in this case, after that December 20th date. If you buy it between December 20th and December 31st, the person who owns it on December 20th gets the dividend. It's going to them. You figured out who owned it on that day, and that's who you're writing the check to. So what happens between the 20th and the 31st is they write all the checks, get it all together, and send them out. Got the idea? So they're going to get the dividend. So ex-dividend means you don't get the dividend. If it doesn't say ex-dividend, you're going to get the dividend. You're still before the record date. Or maybe there's a dividend out there. Right? Got the idea? Okay, so it really matters if it's ex-dividend. Would you pay more for the stock if you get the dividend than if you don't get the dividend? Sure. So it affects the market value of the stock. All right. So on the date of record, guess what you do? No entry. Tell me no entry, please, when you do a quiz or test. I'm going to tell you, oh, December 20th or whatever date. That's the date of record. There'll be a blank spot there. Don't leave it empty, right? Say, no journal, okay? Nothing happened, okay? But then on payment, what happens? You get rid of the dividend payable because you paid it. Just like any other liability, debit it, credit what? Cash outstanding. That's it, that's the whole thing. No matter how big the dividend is, no matter whether preferred shareholders get it, common shareholders get it, or they somehow split it. Got it? That's always the entries. Those are easy, aren't they? Okay? So let's figure out who gets what here. How much of that 200,000 dividend goes to each one of these types of shareholders? Okay, what do? How much goes to the preferred shareholders? They get theirs first. And how much goes to the common shareholders? What did we say preferred was? It's 5% dividend, which was on a $100 par. 5% dividend on a $100 par is $5. 1,000 shares is 50,000. It's non-cumulative this time, so even if you hadn't paid dividends in prior years, it doesn't matter, right? Those years are gone. Okay. So how much is going to be paid out in dividends total? $200,000. Everybody agree? So we said. Okay, so it's going to be paid out in total. How much do preferred shareholders get? They get the first 50,000. This is unbelievably easy. And what do the common shareholders get? The other 150,000. So they get theirs second. Whatever's left. Got it? How about if I only was going to pay 30,000 dividend? Who would get it all? Preferred shareholders get it all. How about if I was paying $1 million in dividends? Preferred would still get 50. 950,000 to go to common. Got it? It's easy, isn't it? Okay, anyway, per share. This is total. What if I asked you to do per share? Now what would we do? How many shares are there of preferred stock? 1,000. It's 50,000. We already knew that. It's $5 a share. We calculated it, didn't we? Everybody agree? Common, you're going to have to calculate something. What is it, $150,000? 100,000 shares, what's that? $1.50 per share. Everybody good? Can you do that for me? Okay. Let's change it. Let's say it's still that big a dividend. Okay? Still going to do the 200,000. But this time, what we're going to do, so this was the non-cumulative, right? Let's do cumulative, okay? And let's say that there's 2 years in arrears, what we call it, behind, arrears, like a rear, I guess, the rear. 2 years in arrears, okay? What does that mean? I have not paid dividends for 2 years. Everybody got it? And that means I can either say 2 years in arrears, including the current year, which would mean what? They get last year's dividend and this year's dividend, and preferred to before complicated anything. Make sense? What if I say it's 2 years in arrears, not including this year? Then they get the last 2 years plus the current year. So read carefully. If it says not including this year, obviously you got to do this year's too, right? If it says including this year, it's already included. So read carefully, right? Pay attention. Okay? You guys are getting pretty good at that, right? So that's it. Okay. Dig in again. Right? Read carefully, quickly. All right. So anyway, how much am I going to give the preferred shareholders? What do they get first? Out of the total, what are they going to get? What do you think? They're going to get 50,000 what? For each year? Everybody with me? It's 5%, which is $5 times 1,000 shares. It's 50,000 for each year. It's 2 years in arrears, right?
How's that 50,000? How's that not just 5,000?
Oh. It was, wasn't it? Oh, it is 5,000. Oh, geez. That took a long time for somebody to say something.
Well, because I'm sitting there asking her, and I'm like, well, if it's $100,
Yeah. I did 10,000 shares, didn't I? Oh my gosh, you guys. It's 5,000. Okay. So what would happen? Thank you. What would happen? Well, thank you for finally. Yeah, that's all right. I didn't mean you guys today, so you're losing your confidence, aren't you? Okay, so anyway, $5,000. Come on, Keith, I even wrote down 5,000. Okay, so 5,000, not 50,000. So what happens first if it's non-cumulative? How much do the preferred shareholders get? $5,000, which would be $5 a share, right? Okay. What would the common give though? It's 100. If it's 200, they'd get 195. So take 195 and divide it by 100. What do they get? $1.95. Is that what that is? Okay. Great math skills, Steve. Okay. Got it? Thank you. That's amazing how long that took. It must be me. It must be me. Yeah. Now you can always assume I made the mistake. Okay. So what would it be if we're splitting the 200,000 and there's dividends in arrears? 2 years in arrears, so let's say it's not including the current year. Yeah. For the last 2 years, it'd be a 5,000 each year, right, that are in arrears. And then this year, right, so that's not including this year. So we'd have 3 years, wouldn't we? Everybody got it? Times 5,000 is 15,000 for the preferred shareholders, right? What do the common shareholders get? 185. And that's it. Okay? Could you do this? Okay. So 15,000 divided by the 1,000 shares is how much for the preferred shareholders? 15. Well, we know it's 5 3 times, right? So $15. How much would be for the common shareholders? We got 100,000 shares, wasn't it? $1.85 a share. Okay. By the way, can you tell by how big the dividend is, how good that is for each one of the shareholders? Not really. You'd have to look at the market value per share, wouldn't you? If the preferred shareholders paid $100 a share for their stock and they're getting a $5 dividend, that's only 5%. What if the common shareholders' market value is only $10 when they're getting $1.85? That's 18.5%. Got the idea? Okay, it might be a much better dividend. Okay. What if the common stock selling for $50 a share? That's not a very big dividend, right? $1.85 on a $50 share. So it depends on the stock's market value. So that makes sense, guys? Okay. So. I have down here, today is Tuesday, July 15th, right? I have down here that the time in between the two classes we could spend getting ready for quiz 10 and 11. Because we're just going to do it tomorrow morning at 10 o'clock. So if you can stay, I'd be happy to work some of the quiz problems with you. If you can't stay, that's fine. Anybody stay? Stick around if you can. If you can't, that's fine. Study, 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 study. Look hard, guys. And now that I yelled at you, now that I gave you bad news, made fun of you, keep your confidence, keep your work going, or get it going again, right? Dig in and go after it, okay? Good question.
You have a good day.
You too. Lots of points left.
You record this?
Yeah, sure. You can record it. What, are you guys going to your English class or something?
Yeah.
It doesn't start till noon. Gotta eat something. Yeah, I'll start it again. Record another one. Let's do that. You don't have to listen to this again, all screwed up.